welcome everyone to episode 64 of Top of Mind with Hao and Chris. Today we're going to talk about what happened in 2024, the winners and losers. Specifically, Hao made a bunch of predictions for 2024. He always releases his predictions, sure to be wrong newsletter in the early part of the year. So we wanted to debrief that, go over what was right and wrong. And then we're going to shift into 2025 and talk about what we think is going to happen. Just, again, predictions. We're going to have Hao go and we're going to have me go. And then finally, there's also a kind of an interesting news bite on the Mag 7 and the contributions to earnings, or the expected contributions to earnings. And I thought that was kind of an interesting thing to take a look at. Before we dive in here, because we are going to be talking about specific stocks, we're going to be calling out certain things in our predictions. I have to remind everybody that the information that we discussed today in this commentary is really just our best guesses. We are not making a recommendation to buy into or sell out of any of the stocks that we might mention today. All of this and everything that we discussed today should be viewed in the context of a well-diversified portfolio. So, please take it that way. If we call out a company and we say we think it's going to do well or not do well, that is not in any way our way of saying go buy that stock or short that stock or sell that stock. So, and of course, these views and predictions can change over time quickly. New information comes available quickly on earnings reports and economic data, and of course that can change things. Everybody should know that we won't change our predictions. We're going to tell you a year from today what we got right and what we got wrong. But again, definitely don't act on something that we say today, because things have a way of changing. Okay, with that, let's kick it off. Hao, I want to turn it over to you. Predictions for 2024 from your newsletter. What did you talk about there, and what was right and wrong?
Yeah, we talked about 3 topics, all wrong. So, spoiler alert, I got nothing right. The first will be the rest of the market will catch the Magnificent Seven. So famously, I want to say over the past 2 years, those Magnificent Seven stocks, right? NVIDIA, Google, Apple, Amazon, right? All created what we call market concentration, right? The S&P 500 has 500 stocks in it, and only 7 of them have done exceedingly well, bringing up the whole index with it. Our rationality, I like that. I'm trying to think of the word. Our rationale behind it was the rally was going to extend beyond those 7. So 493 beneficiaries of what was good market performance, but was driven by just 7 stocks. That needed to kind of broaden out and give love to the other 493 names that have, been pretty largely ignored. I know we quoted on a past episode, if you took out the Magnificent Seven, the rest of the market index was up like 5%. So very middling. So the Magnificent Seven was up 28% last year versus the S&P 13%. And that was, that was showing, again, I did this mid-year, so the S&P was up 25% last year. So the Magnificent Seven, I believe, was up 31%. Let me just pull up our Magnificent Seven chart here.
I was going to give you more credit.
Yeah.
I was pulling this up too. I was going to give you more credit because for a lot of the year, the S&P was above the NASDAQ, which was, to your point about the 7 top companies leading the market. The NASDAQ has a lot greater weight in those 7 companies, and so it can stand to do better or worse if those companies do better or worse. And the S&P was a good clip ahead of the NASDAQ, which we would tell everybody that suggests markets are healthy, because, the 493 are actually doing something. But then towards the end of the year, that changed.
Yeah. So, here are the official numbers. The Magnificent Seven up 64% last year. And then the S&P and the NASDAQ up 25%, and the equal weight up 12%. So the equal weight just kind of nullifies the market cap weighting, meaning if you're a bigger company, you're getting more outsized exposure in the S&P, which we think is the right way to do it. Like the biggest companies get the biggest chunk of the index versus everyone diced up 500 equal parts. But the RSP is a indicator of how the rest of the market's doing relative to the biggest companies. So 12% return over 2024 was pretty bad relative to the biggest companies alone, and then relative to the S&P traditional weight.
That's crazy when you look at it like that. 64% versus 25.
Yeah.
That's wild.
Yeah. And people are going to chase. I get it. But again, there has to be, the thought of competition coming up to catch NVIDIA or Amazon or whatever, but not the case in 2024.
NVIDIA is the most valuable company in the U.S. now.
It is, yeah. 3.53 trillion.
Crazy.
Yeah.
Crazy.
All right. The next topic, the Fed will not cut rates. We were right. Well, I was right until September where the Fed did a double cut. And there are times when people doubted that, right? Like they cut too early, prematurely, which is ironic because those same voices were saying the Fed should have cut in July. So, make up your mind. The data that they look at are jobs, right? How strong is the jobs market? That's really been rocking the Fed's thesis of cutting rates, and inflation, right? So the dual mandate is jobs and inflation. Jobs runs too hot, right? Inflation tends to go up. At least that's what the common thinking is. And the Fed cut essentially 3 times last year. One was twice in a single meeting, but that was pretty aggressive. That was the first time we've cut in an era where we didn't have a recession. Cut twice, right? So we cut twice in a good market, and that was definitely celebrated at the time. But the bond market responded by saying that seems so aggressive, and the rest of the bond market, which the Fed does not control, right, specifically the 10-year Treasury, went up since September. So that's a big divergence between what the Fed is assuming and what the bond market is saying yes or no to, right?
So say that again. That was the first time the Fed has cut by a double cut, which is 0.5%.
0.5%.
And us not being in recession?
And not being in recession, yeah.
Wow.
We've done it before, but it's always been in recession. It was
right.
2001, it was 2008, 2009, and this is odd. Maybe the Fed chairs are listening to what the talking heads are saying, but they caved. Now the talking heads are saying, well, they cut too prematurely. Again, that's why the Fed's in the Fed, and those talking heads are talking heads, not in the Fed. I wish they would be a little bit more, less pliable and stood their ground, because I think we rightfully believe they should have paused. Right, and inflation's still, 3%?
I remember I was aligned with you on that one last year. I said that the Fed wasn't going to cut either. So they did. It hasn't done really anything to rates other than CDs and money markets and variable credit. So,
all right, the next one, the dollar will weaken. Now that I'm typing it out, this is in contrast. These two things couldn't exist. If the Fed kept rates high, the dollar would actually have strengthened because everyone else is cutting and the Fed wasn't in our mind. So we should have said the dollar will strengthen, because when the U.S. rates are higher, that means there's no more demand for U.S. dollars because it's earning higher interest rate. That's not the case. The dollar actually strengthened because the Fed still cut, but they waited basically the whole year to cut. So the dollar had been strengthening really all year relative to other currencies.
I mean, exactly. But you were right. I thought you were right all year, though. The dollar was slowly weakening, and then in the back half of the year with the elections, it got strong again. Is that correct?
Yeah, that's the Trump effect, where more protectionist policies, and that Russia's ruble strengthened when they closed off to the entire world. So it's a similar effect happened with the U.S. dollar.
So wrong. Jeez, tough market.
Yeah, well, it's tough to guess. That's why we always have that disclaimer, because we're guessing something for a whole 365 days, and we don't know what's going to surprise us. There's always going to be a surprise.
See, the analysts just change their recommendations or change their predictions with new information, and that's maybe a way to get closer to being right. But we try to call the play in advance here, which is why we stick to our thesis for the whole year.
You could track the guys who said the Fed should have cut in July, then all of a sudden, in October the Fed shouldn't have cut.
Right, and based on new data, okay, whatever. But
but pick a lane.
We just like to stick to it. So, okay, cool.
All right.
So let's push into 2025. So
I wrote this in mid-December, so I could sense some of these might be already wrong.
You've got 6. Just hold on quickly. You've got 6, and I've got 15.
Yeah.
So
it'll
we're
be a
gonna
fun conversation. This is going to be the meat of the episode. So my first prediction: clean energy will beat dirty energy in performance. I know Trump is very much a dirty energy, like traditional energy, right? Oil and gas. He's very pro pumping, right? More supply. I think. I don't think it needs to be said. During his first 4 years, the return of energy was negative. This is 4-year investment, right? The 4-year performance for energy was negative 30%. Clean energy was up 300% during his 4 years, and he made it life really tough for clean energy to operate. So the fact that performance lapped several times over dirty energy, I think there's going to be a repeat of that.
Just a quick soundbite on what that's doing so far this year. I'm looking at 2 ETFs. I'm looking at XLE, which is the energy sector ETF, and I'm looking at iClean, ICLN, which is the global clean energy ETF. Year to date, by the way, we are recording on January 24th, Friday, and it is 9:20 in the morning Pacific time.
Oh, thanks for the time, Sam.
Yep. Energy sector is up 7.63% year to date, and clean energy is down 1.67% year to date. Let's get a little bit more fun. What about since the elections? So November 5th through right now, intraday, right now, iClean, again, the clean energy ETF is down 16.31%, and XLE, the energy sector ETF, is 3.1% positive since that time.
Yeah, something that's not insurmountable at this point, but again, it's an assumption that history will repeat itself, which is, again, bound to be wrong, but I think clean energy has a chance.
Interesting. Do you put nuclear in clean energy?
Yes. So
these companies that are high flying right now, like Constellation, Vistra, you would put those in the clean energy department?
Yeah, I would.
Okay, that seems fair. Let me see if those actually
And that's
exist.
a bit cheating. I don't think that's in there, though.
Yeah, I want to see, is that in this clean energy ETF? Holdings.
No, it's mostly wind.
Yeah. First
Wind
Solar is the biggest holding at
solar,
7.76%.
Yeah, and throwing nuclear in there would be pretty much cheating, because if you throw those companies, Constellation Energy and Vistra, this index would be pulled up by those two names alone.
If I look at XLE, top holding, wow, 22% of the XLE is Exxon?
Yeah.
There's only 25 stocks in this ETF. That's wild. Okay, so Exxon 22%, Chevron 15.5%, ConocoPhillips 8%, Williams Companies, don't know who that is, 4.67%, and then a bunch of others. So
very old traditional energy names.
Yep.
And again, think about it. If you're an investor, would you want to put your name in those companies? Again, I don't see a lot of growth there. That's really the fundamental reason why picking that.
Well, growth, but it's margins, right? Their margins are highly dependent on the price of oil. But
yep. And oil right now, trading at $74 a barrel.
Yeah, pretty reasonable.
Which I think is in the sweet spot for oil companies. Is if it gets too expensive, again, everyone thinks when oil hits 110, it's going to rocket up to 130, right? And that's just not the case, because OPEC countries tend to pump more when the oil price is higher, and they tend to throttle pumping when oil prices are lower. So the cyclical effect is occurring where the price of oil gets too low, they're going to, artificially stop pumping more or start pumping less, which drives up the price, and then they start pumping more when the price is higher, which drives down the price. But again, we only notice it when the price goes higher.
We are consistently producing more oil. We're pumping more oil. I'm looking at a 5-year chart.
We're exporting. Yeah. The U.S. has been a net exporter for past 6-7 years.
Good point. Yeah, good point. Although, and maybe you don't know this, I know that we buy a ton of oil from Canada. That's the largest import from Canada, or largest export of Canada is oil into the U.S., right? Which means that we must be selling our oil to other countries. So there must be some sort of a arbitrage opportunity that we're selling our oil, getting more money, and then buying Canadian oil. Otherwise, why would we do that? We would just be pumping and using our own oil.
The refineries are different, though, too, because WTI is pulled out of the Permian Basin in Texas. That's considered the sweet crude. And refining that takes a different process than the Canadian oil sands, which is more of a sludgy, sour. It's called like a sour oil. And there's a different refinery type. So you can't refine both in the same facilities, right? You need a specific facility for a WTI and a specific facility for sour, because they're just completely different processes and probably different uses. Again, anyone who knows better, I think one is for diesel production, one's for more common use production.
So, interesting. U.S. consumption. That's okay. It's all over the place. Yeah, I was trying to look at U.S. oil consumption because I think it's actually down, but it's not. It's flat. Interesting. Okay. All right. Next up.
Consumers will not notice tariffs. And I think we'll just track this with Google search stats, but there has been an uptick in tariffs. They won't notice it. I think, again, not to justify tariffs, I don't think we believe in increasing the cost of goods, but we've already had tariffs. We still have tariffs. And we did not have inflation during the first, 4.5 years of tariffs. So it's kind of a common practice for countries to try to protect their domestic industries from other outside forces, right? China famously uses more of a blunt instrument where they keep out U.S. companies, or if you want to operate in China, they own half your business.
Right.
And they have much weaker copyright laws, so they're stealing a lot of IP from the U.S., right? So the tariffs, I don't know if are really necessary. It seems more of like a negotiating starting point. We've heard a lot of, we're going to tariff 25% to Canada and Mexico unless Canada becomes the 51st state. I think that's more of a pot shot at Canadians, which I don't think anyone's crying any tears over, but sorry to all our Canadian fans. But tariffs will largely go unnoticed, and we'll track that by who's actually searching up tariffs, which I think will be minimal.
I agree. I think it'll be similar to what it was in 2016. There'll be some tariffs implemented, and it won't be economic catastrophe. That's certainly what the market is expecting already. If the market was anticipating much stronger tariffs for an extended period of time, you would see probably a much different market effect. Markets sell off in the face of uncertainty, and then once that uncertainty becomes more known and more certain, then they recover, and that's just how markets and public prices go.
I think the market's wisened up. because 2018 was the first round of tariffs, right?
Mm-hmm.
And that Christmas Eve, I remember being here, like trading, not here, but like in this seat, trading for lots and lots of dollars, and we had a pretty sharp sell-off on Christmas Eve, right? And that year was what I believe 2018 was down 18%, and then everyone wised up, and 2019 was one of the best years on record.
Mm-hmm. We'll see how it shakes out. I agree with you, though. I think it's not going to be noticeable, and I think it'll be...
Yeah, the market, like you said, is ignoring it. And I think they learned their lesson from 2018.
All right, U.S. debt.
Despite what Doge is touting, I don't think we're going to get meaningful cuts, especially if we cut taxes. The U.S. debt will grow, yet no one will care. Again, we'll track this by two things: how much the debt has actually grown, because it looks like the Tax Cuts and Jobs Act will pass, and it looks like we'll probably increase SALT cap limitations. So right now, the SALT cap is just the state and local tax cap, meaning you could write off up to $10,000 of your local taxes, right? Property taxes, state income taxes if you have one. And $10,000 isn't a high ceiling for a lot of people, especially in California and New York. So if they raise that, or I guess uncap it, that's going to create another, revenue shortfall for the IRS. So I think the U.S. debt will grow if we could somehow cut big slices of government spending, which I don't know. Everyone points to government employees, but again, if you just look at their salaries relative to the amount of spending across everything else in terms of Medicare, Social Security, defense, which are the top three, I don't think government worker salary is the biggest thing you could cut there, right? You could eliminate all government workers and you still have a massive deficit because you're paying out all these entitlements. And then we'll track with Google search to see if anyone's even looking at the U.S. debt or the deficit. I doubt if they will.
I think the whole Doge thing is going to be the most interesting story to watch. Be very interested to see how that goes this year and really over the next 4 years. I want to disagree with you. I want to think that we can balance the budget.
I hope so. I hope they find something, but I'm just super doubtful of it.
Yeah. All right. Next one.
All right. The market will only produce 10 new all-time highs. This sounds like I'm bullish. I am. I'm cautiously bullish. But if you look at the data, the market actually produces, on average, per year, 16 new all-time highs. Okay. That's just an average year. Already, Chris, as we talk, we've already had 2 new all-time highs. So I'm already in the hole for this one. So we can't produce too many new all-time highs for the rest of the year, which I think this one's dead in the water. Well, to my surprise when doing this research, I was really surprised to see 16 new all-time highs have been generated since 1950 in the stock market.
Every year, yeah. That's
every single year.
4 a quarter, so every, 3 weeks?
Well, I should know better, right? Because I always point to that S&P chart going back to the 1950s, and it's like a straight line up.
Yeah.
Obviously, those are new highs every time the line goes up, right? So
I think what you're suggesting is that this year won't be as straight up. That's what you're saying, right?
That's what I'm saying.
If a year is straight up, then you new high after new high after new high, and you get to 20 or 25, or I don't know what the number would be for a year like that, right? This year, likely not as straight up as last year. I think
exactly.
That's ultimately
expect some volatility, yeah.
Yeah. Okay.
Easy to measure that one.
Yeah.
All right, so unemployment will stay below 4.5. I wrote this when unemployment was 4.3. It's now 4.1%. So,
ding, ding, ding.
Doesn't sound like I'm going out on a limb. At the time, it did seem like it, but we had a jobs report that came in 100,000 more jobs than expected, which is cause for concern in terms of if you think inflation is going to be reignited with jobs, which again, I think we've talked about the Phillips curve and how that relationship is pretty much breaking down since the 1980s, meaning you'd be right to think that the more jobs we create, the more wages go up and the more inflation goes up. We actually have not seen that happen since the 1980s. I think technology, the advancement of, assembly lines to production to everything has gotten so much more efficient. Mm-hmm. And I think even if you pay people more wages, you're getting more juice out of the squeeze. You're getting more production out of them. Mm-hmm. I think that's why you're not seeing as much inflation as the number of jobs grows or the wage growth grows.
Okay. I agree with that one. I think the only thing that blows that one up is if we fall into a recession. But that probably blows up all these, right? So
yeah, it does.
Yeah. All right. I'm really curious about this last one.
This one's bad news. Yeah, the housing affordability index will worsen during the year. It's just showing how doubtful I am about rates, about the mortgage industry, about the real estate industry. It's just the housing affordability index has peaked in post great financial crisis, when it was probably the best time to own a house was in 2011, when jobs were coming back, right, and the prices of homes had come down. So now you had a perfect match. That index, again, we're using these index points as reference, though. So that index at the time, at the most affordable point, was 200. Mm-hmm. Right, and the scale goes from 0 to 500, I guess. And then right now, the line comes down to 100. So it's now half as affordable as it was in 2011 to buy a house. In 2011, we actually did not recover from the recession until 2013. So we were still in the recessionary trough during that time, and housing affordability was still much better back then than it is now. Interesting.
So I pulled up this chart as you were talking here. This goes back to 1981.
Yeah.
U.S. fixed
imagine
housing.
Being in 81, you couldn't afford to buy a house. You know why?
Interest rates were crazy.
Yeah, they were 20%.
But no, it was pretty good. I mean, it was. Oh no, it wasn't.
Yeah,
okay,
it's the other way around. Yeah, the higher it is, the more affordable the house is.
Okay, so good news. It's not as bad as it was in 1981.
No.
Everybody thinks housing's bad. It wasn't as bad then. So it was like 70, and then it actually got to a bottom of about 63 in August of 81.
Yeah.
And then affordability has really gone up, gotten better all the way until...
Through the 90s, yeah, really good affordability.
Tech bubble.
Yep.
The
affordability dropped when the housing market got really to a fever pitch, but it still was better than it is now, which is kind of crazy.
Okay, but barely. July of 2006, it was 100. It's 99 today. That's same.
Yeah.
But then the great financial crisis happens, and we went from about 100 to 200.
Yeah.
Because rates fell and values fell. So all of a sudden, yes. I mean, that was that era of like, why am I paying rent when rent is the same as a mortgage payment?
Yeah. And now the trend has reversed, right? It's actually makes a lot more sense to rent in this market than buy.
Yeah. So it was a slow decline as things sort of recovered, which got, I guess, kind of got the worst in July of 18, and then interest rates started to change again. January of 2021, remember that? We went back to zero interest rates around COVID.
Yep.
So it went from 137 index to 187. Remember, higher number is more affordable. And then coming out of COVID with really kind of just stock market frenzy, and then the housing prices went crazy.
Yeah, maybe it helps to take a step back and explain what the housing affordability index is like. Really,
can you? Actually, that's great because
it takes the average home price and lines it up against the average salary, then it also includes like the interest rates for mortgages, right? And then those big items mixed together will say, hey, it's actually pretty affordable to get a house, or it's actually pretty tough to buy a house in this market, right? So the affordability index is I think for reference, is actually a good reference. Hasn't been this bad since 2006.
Okay, what's confusing to me here, though, is that January of 2021, it was at 187. And then it plummeted all the way back down to right about 100 in like July or so of 2022. So we all know what happened there. Stocks went crazy coming out of COVID. 2022 then was a bad year in stocks, but real estate kept going up. But then also interest rates shot up.
Yeah.
Right? 2022 interest rates on mortgages went from...
got worse and worse there, yeah.
But hold on, it didn't. That's what I'm getting confused on here. Because in June of 2022, it was at 94.5, and now it's at 99. I would argue that housing is not the same level of affordability today as it was all the way back in 2022. So what am I missing there? Salaries are up, I guess?
Yeah, I would guess it's kind of... Since 22, we had that big spike, right? And I think since 22, we've seen the appreciation of home prices go up still, but not like in 21, right? Like not. So that's probably why the index slowed down.
Yeah. So this would say, if I'm kind of understanding this correctly, the appreciation has, like, salaries have sort of kept up with the appreciation of homes and pushing up prices, and that also, because it's been slower appreciation in the last couple of years than in the prior era, that has somewhat offset 6% mortgages versus 3% mortgages.
Yeah, and I think people are screaming as salaries. So the timing of it is probably off too, because the home prices shot up and then salaries started catching up, but there's still this gap, right? I think that's what the issue is.
It's just weird that it's reading like the same. I would suggest that today is far better than 2.5 years ago. Sorry, far worse than 2.5 years ago, because rates are still stuck.
Again, our feelings would say so, but again, I would probably point to places like Austin, Texas, where there has been a bit of a pullback.
Good point.
Maybe some of the metro areas are kind of going back to their averages or regressing a little bit, because whatever the reason, right? Work from home is no longer a thing, or people moving to areas are like, well, I didn't think the job market would be this bad in this area, or I hate my neighbor. Whatever the case is, who knows? But that's kind of what the biggest trends are showing.
So you think rates, because you think rates will... So why do you think it's going to worsen?
I think rates will remain high. Well, throw all that out. It's going to be supply versus demand.
Okay, fair enough.
We just don't have enough homes.
Yeah.
And I can't snap my fingers and have homes suddenly spring up. Mm-hmm. And do you remember when we talked about these home builders were buying points for the new home buyers?
Still happening.
That's coming home to roost, right? A lot of the home builders during earnings was like, yeah, we've bought down over the last 2 years, and it's really tightening our margins, right? So that's probably a game that the home builders can't play for too much longer.
Interesting. All right, we're going to shift gears here. I've got 15 to blow through, and I'm going to try to do that in 15 minutes.
All right.
Just because I don't want to run too long here. So prediction number 1 for 2025. Mortgage rates end the year between 5.5% and 6%. I think I would align with you on that, right? So mortgages right now are about 6.5%. You feel like that's roughly accurate?
I think so, yeah. Yeah.
Depends on who you talk to and,
yeah,
credit and all that stuff, but about 6.5%. I think we see sub 6. I don't think we see sub 5, and I think it hovers between 5.5 and 6.
I think if we see sub 6, it's gonna psychologically do a lot of things.
Yeah.
It might increase demand again, so we'll see.
I agree. I think you could be right on that. All right, so that's number 1. Number 2 is inflation falls, but only a little. So inflation is not at the Fed's target yet, but the rate of decline has been falling. This actually also goes into number 3. Let me just say number 3, and then I'll tie these 3 together. So number 3 is the Fed only cuts twice. So I think the Fed is going to continue to cut interest rates by 0.25% each time, but that they're going to do that twice in 2025. So I want to tie these three together. I think that growth actually accelerates in 2025. I think that inflation mostly holds, like it declines, but only a little bit. I think that's why mortgage rates only fall a little bit, because growth accelerates. And I think that's why the Fed only cuts twice versus 4 times or no times. So just tying all those together, I did not put a prediction here that I said U.S. growth will accelerate, but those three are kind of tied into that.
Yeah, for reference, the bond market is pricing in 1 cut this year.
Oh, interesting. Okay.
Yeah.
That's changed recently then, no?
Yeah, I guess the divergence, though, is from our point of view, is pretty large. The bond market is differing from the Fed by 1 full percentage point. So the Fed still has a forecast of roughly 4 cuts this year. The bond market has 1. Or, sorry,
no,
for the
2 and 1.
2 and 1, yeah.
I mean, that's a 50 or 100% difference depending on how you look at it. So
yeah.
That's a big,
big ramifications if the bond market gets their way.
Number 4, the Mag 7 gets a new name. Come on, it's been called the Mag 7 for too long. So, it was like FANG, and then what came after FANG?
FANG with 2 A's.
FANG with 2 A's.
Because Alphabet, because Google, whatever the second A was, I can't remember.
Yeah. Anyway, so it's like, it's been the Mag 7. Something's going to change. Some new company's going to emerge, and we're going to rebrand the Mag 7. I don't have any context on that. I'm just throwing it out as a prediction. Okay, number 5. The IPO market heats up. We see a record number of IPOs in 2025, with the exception of 2021. All right, IPOs. There's been not very many IPOs in the last couple of years. I've actually got a chart or some data on this. So in 2024, there were 225 companies that went public. In 2023, there were 154. In 2022, there was 181. Why am I leaving out 2021? Because there was 1,035 companies that went public. Why? That was the SPAC era.
Yeah.
And if you looked at the data on the amount of companies that exited and then the performance of those, it is absolutely atrocious. So companies were basically just going public to cash out investors, get listed and keep going. And it's been a terrible thing for those companies being in the public eye before they should be in the public eye.
Yeah, and even worse for the investors, right? It's just, what's the luxury vehicle brand that's backed? I can't remember.
Oh, Lucid?
Yeah. How are those investors doing?
Yeah, well, I think that you have a good perspective on this. I don't know how I should think about this. So if I'm a private company and I'm backed by VCs, those VCs at some point are going to say, hey, I want my money out.
Yeah.
And they're going to say, look, the market's crazy. Just go. And those VCs get out. Also, think about all the employees that have stock that then converts into real equity and they could sell. I think your suggestion is, what if they didn't and they held on from $10 to 98 cents and it all evaporated? And I appreciate that point. I think that's a valid point. But if you consider just the value of some investors, and particularly the early on ones, just having a liquidity event, like liquidity is key. Mm-hmm. That's the key of U.S. markets.
Someone else has to buy your asset from you.
Well, see, and that's a great point, right? If I sell at $10 and somebody bought at $10 and wrote it down to $1, joke's on them, right? And that's not necessarily, that's not good, but it is just how the free market works out there. So I don't know. I appreciate your view on it. I guess I try to look at it as a lens of, if I were in those shoes and my VCs were saying, you got to go, everybody's going, and you're getting silly valuations. Yeah. I mean, I think you got to go.
In their position, yeah, you got to sell and not really think about the other consequences of it, because you got to look out for your best interests. And that's what you're saying, right?
Yeah, and from a company standpoint, if you can raise more money on that IPO, because remember, companies only raise money when they issue new shares, which is an initial public offering, or sometimes they can issue additional shares down the road.
Yep.
But let's say that they don't, right? Let's say that they just issue their shares on the public market, and then they get cash in their bank, which they can use to then invest in their business and grow it. And a lot of people don't fully get this, but when I sell a share of Microsoft and Hao buys it, Microsoft doesn't get any money. That's just trading hands between Hao and me.
It's considered the secondary. Everything on the stock market is secondary trades. Yeah.
Secondary trades, exactly, versus initial or primary. And so I think if you're looking out for the best interest of your company and the market is saying, well, you're worth, $1 billion in this market versus you should probably be worth 600 million in another market.
You got to take the.
You kind of take the money.
Then,
yeah. Yeah. So I don't know. I think that's how I look at it. But I do appreciate your perspective because it's
well, mine always falls back to financial education because you see a Lucid SPAC run up. I can't remember the ticker of that one, but you see it happen with SoFi too, right? It just created this fever pitch, and people are buying without doing the proper due diligence. And one, I think you're saying is you should expect them to do that properly, but I don't think we saw that, right? We saw a lot of craziness with not just SPACs, but with the NFT bubble, crypto bubble. And again, do we feel sorry for any of these suddenly poorer people? I don't know. That's hard to say because I wish they had better financial education, but where does that even start? Because let's say you're designing a financial literacy curriculum. It's probably going to be stale in 6 months, given how fast some of these things are moving, right? Because how could you talk about SPACs for someone in 2025 when that wasn't more of a 2021 thing, right? And that's very, again, that some protection may be warranted, but it's hard to regulate something that's so quick and so new, and people jump on board so quickly.
All right, so Lucid went public at $10 a share. This is January of 2021. By February of 2021, it was at $60.
Yeah.
6x. By March of 2021, it's back down to 22.
Yeah.
And then it kind of hung between about 17 and 27, which is a huge variability for a while, actually. And then it in October of 2021 spiked again from 24 back up to like 55. And it's been going straight down ever since. Today it trades at $2.88.
Yeah. And I think, again, that's kind of like the trial by fire or born in fire. It's just, I had my similar SPAC experience in 2000. So I hope people who lost their shirts were compelled enough to stay in the market in some other form and find ways to invest more responsibly, I guess.
All right, I want to bring us back here. So 2021, 1,035. It was a frenzy. 2020 started a little bit of that. There was 480. But all the rest of these numbers on this chart are between like 100 and 250. Yeah. Now, 2008 was only 62. 2009 was 79. 2010 was 190. So why do I think that we're going to have a record, which means more than 480 if I take out 2021? Because I think that there's a lot of companies that have not gone public in the last couple years because the environment hasn't been right, interest rates, valuations, whatever. I think if we've seen anything in the last couple of weeks, you've seen mid and small cap companies jump in terms of valuation. I think that's going to push VCs to say, go, get out, exit, get the money, take it and run, reinvest. So I think we're going to have more than 480 IPOs in 2025.
Yeah. I think 2021 was unhealthy, but I also argue that 2024 was unhealthy. From both ends, right?
Let's move. Gold, number 6. I think gold falls in 2025. Gold has been going up for a little bit, and I think it's ripe to go the other direction. Why? Because it just doesn't keep climbing at an outsized rate. Gold actually had a really good year last year. If you look at
36%.
Yeah. So like if you look at the S&P and you look at gold,
Or 26% for gold.
And you look at a chart here. Boom. All right. Okay, interesting. Sold off a little bit. 26% versus the S&P at 23. It just doesn't normally keep up. Like gold generally underperforms. It's generally not a great place to park money. It doesn't seem to be a hedge for things. People think it is, but it's not. I think it falls in 2025 because the trend reverses. Number 7, U.S. dollar stays strong. I just think it will. I think that it probably should get a little bit weaker, but I think that with the administration coming in, I think the dollar is going to remain strong, at least for 2025. As I tell all of our clients, go spend money in other currencies. We're going to Canada this weekend. We're going up to Vancouver. Has anybody looked at the exchange rate recently?
Yeah, Canada dropped off like a cliff.
USD to Canadian dollar is $1.43. That is so good. If you look at the trend, it's been kind of climbing and climbing. And I mean, I remember skiing up at Whistler in, gosh, I don't even know. I got to think about that. Probably in the early 2000s, probably mid 2000s. And I remember skiing up there, and the price adjusted in US dollars for a Whistler ski ticket was the same at Stevens Pass. It's like, well, this is a no-brainer. Let's go. And the snow is 10 times better.
And Whistler's the premier mountain. Like
totally. It's a real mountain. It's
a global destination. Like people from all over the world go there.
Mile of vertical, all that kind of stuff. Well, it's even better than it was because it got a lot worse. It went down to almost $1 to $1. Anyway, go spend in foreign currency, everybody. Go to Europe, go to Mexico. The peso.
Go to Asia, go to India, go to.
Pesos Southeast are 1 to 20.
Yeah.
I think last time I was down there, which was a year ago, actually. It was like February of last year. Yeah, it was like 1 to 16.
Yeah.
This is great. So anyway, I think take it while it's here. Just pull up those charts on Google or something and look at the long-term trends and convince yourself to go internationally this year.
Best time for a U.S. traveler. Best time for a U.S. traveler. All right, 8. Wall Street says, show me the money on AI spend. We've been talking about this for a while. Yeah, we're seeing this happen right now. Yeah.
We're seeing this happen right now. And what I mean by this is in 2024, if you just said AI on your earnings calls, your stock went up, right? Now, I think Wall Street comes back and they say, okay, how are you making money? Meta just came out this morning and said 50 billion? 65 billion.
Yeah.
Meta says we're going to spend up to 65 billion with a B on AI in 2025. Google came out last year. CEO Google came out last year and said it is more risk to be overinvested. More risk to be underinvested than overinvested in AI. Microsoft corners the market there with their, I said OpenAI, in AI. Microsoft corners the market there with their OpenAI investment. So I think that there's going to be continued huge spend on AI and the build out of it. And I think that Wall Street is going to say, you're spending 65 billion. Show me how you're monetizing this.
Yeah. Remember in 22, Meta got criticized for overspending on virtual labs and all that.
Yep.
And their stock cratered by about 60-ish%. So.
Yep. And they had no revenue on that.
It could cut both ways. So just.
It could cut both ways.
Be cautious. Yeah.
Okay. Number 9, the S&P beats the NASDAQ and small caps beat the S&P. Oh, big news there.
Yeah. But it's a big, bold statement because small caps are more sensitive to higher rates. So if rates remain higher, that could be pretty much a death knell, deregulation or not. I think that's a bigger component of small cap valuation than someone potentially buying them out, right?
I think small caps still do well because I think that valuations go up because I think interest rates will come down a little bit, not a lot, and that'll help their bottom line. And I think that M&A activity is going to spike, which I'll get to on number 11. But I think that's going to be a good year result in a good year for small caps. And I think small caps beat the S&P. S&P beating the NASDAQ. I just kind of just hope this happens, because it would be really nice to see those 500 companies do better than the 100 that are sitting in the NASDAQ, just in terms of like outright valuations in markets. That would be a healthy thing. So
that means other sectors are doing better or as good as tech, or tech related.
Yep. Number 10, the S&P has one correction in 2025. A correction is defined by a 10% pullback from a prior high, and the NASDAQ draws down 15%, probably during that same time, but we'll see. So S&P has one correction, 10% drawdown, and the NASDAQ draws down by 15%. Average drawdown in any given year for the S&P is between 14 and 15%. It's like 14.6 or something like that. So this is normal. I think I'm suggesting that we will have at least one of those in this year. That is normal, but we didn't really get that last year. So I think there's one this year. All right, this one's big. Number 11, financials are the best performing sector in the S&P 500.
You got a 1 in 11 chance of being right there.
Thank you.
9%.
That's good.
9 or 8 or 9% right. Odds.
I'll take those odds. It's pretty good. So financials have one of the things that came out of the election. So elections happen day after. So it's November 5th. And JP Morgan, Bank of America, big banks were up like 9%. It takes a lot to move a bank 9%. You can sneeze and have a tech company move 9% in 5 seconds. A bank to move 9%, something has to fundamentally change. What's being priced in to banks is that there will be a lot of M&A activity, and banks make a ton of money on fees when they're negotiating and doing all that stuff related to M&A. Far more than they do, selling mortgages and that kind of thing. So I think that financials will have a great year and will actually even beat, information technology, consumer discretionary, these other areas. Again, all because of M&A activity. It's the best performing sector in the S&P. I believe it was number 2 last year, much of which of it happened at the end of the year. So we'll see what it does. Okay, number 12, Meta goes over $2 trillion, which is $800 a share, and becomes a strong number 2 in AI behind OpenAI and Microsoft. That's bold. What do you think about that?
That's a lot of money, and they have to prove that the spending is justified. So that could play out. Again, if you're thinking of Meta just because Chris said so, just pump the brakes a little bit. But full disclosure too. We own Meta for one of the stock models. So yes, we hope that to be the case. Our price targets are higher than they are today. Again, take price targets with a grain of salt, but it's not out of the realm of possibility.
I think that Meta has done a phenomenal job and almost a secretive job on pivoting their whole model around AI. And what I mean by that is their ad model. So obviously they make money on ads and the ad placement. When Tim Cook of Apple came out and said, we're going to put a little thing on your iPhone that says, do you want to share your data with Meta? And a lot of people clicked no, and it freaked everybody out. And, Meta doesn't own their Rails, right? Like they have to be on a phone, which is a Google device or an Apple device or on a computer.
If they could, circumvent that all of a sudden.
Yep.
Boom.
And so it's like, wait, if we don't have, cookies and tracking and stuff, how are we going to be relevant? And they completely rebuilt their ad model. And from what I've heard, advertisers say it's better than it ever was before.
Yeah.
So I think that they actually have monetized AI possibly better than everybody else. Everybody else is kind of still spending to figure out their place. And I think Meta has done that. And I don't know if that's totally realized yet.
They're 1.6 trillion market cap. And let's say they get to the size of Microsoft, which is double. Mm-hmm. We're looking at a $1,200 stock here.
Yeah, which I think is possible, but I think that I think at some point if Meta continues on this path, they blow through Alphabet, but I don't think that happens in 2025.
Yeah, because that's hundreds of billions of dollars that need to come in.
It would be 800 billion.
Yeah,
call it $1 trillion, right?
Yeah, and if TikTok does stay alive, then that could be something that is viewed as negatively, because the cash cow for Meta is still ad revenue and viewership, right?
Right. All right. See what happens there. Number 13, Google can't get AI right.
Kicking someone while they're down.
I just think so. I was using ChatGPT recently, and the amount of improvement now versus even just a couple of months ago is astronomical. It's awesome. And I just think that they're at the forefront over there. And obviously that is piping into Microsoft pretty well. But I think that Google just kind of keeps trying things and can't quite get it right. I think Meta and Microsoft own AI, at least in the short term.
Yeah.
Number 14, Tesla makes a big announcement that's not about cars to justify their stock price. Come on, it's got to happen, right? Nothing's happened with Tesla between the elections and now, and the stock's doubled. So
yeah, nothing fundamentally.
Nothing fundamentally has happened, right? And so they have to do something that's outside of cars. That obviously Wall Street is banking on that, right? Otherwise, they wouldn't be worth so much. Not obviously, but it has to be. And so I think that they make some sort of a big announcement which I think the street rallies initially, but then comes back down, and I think that they do that in order to justify their price. Last one, number 15, Apple is unseated as the most valuable company in the U.S. Okay, this actually already happened. NVIDIA went above Apple by
a few billion, right?
Yeah, 200 million. That happened pretty recently. Apple's not started out the year that great. NVIDIA's come up a little bit, especially with the announcement of that new AI investment, which undoubtedly NVIDIA will benefit from. By the way, NVIDIA, about 100 billion of revenue, worth more than Apple at 400 billion of revenue, worth more than Microsoft at 250 billion of revenue, worth more than Amazon at 620 billion of revenue, and Alphabet at 340 and Meta at 150. Tesla does 100 billion of revenue. NVIDIA does about the same. Pretty crazy that they're worth that much. We'll see if that continues. But anyway, my prediction is, yes, Apple is already the number 2, but I think they fall a little further. And I think that they are no longer the number 1 company by size in the U.S. They've been there too long, and history would suggest that that just doesn't continue for a long time.
All right, that's the big predictions list. So we'll say this for the end of the year, or the beginning of next year, see how right or wrong we are, because there's going to be something that we just didn't see happen, and it's going to be thought changing. It's going to change the way we thought about this year.
Yep. Okay. All right, that was fun. We'll see what's right, we'll see what's wrong, and we'll see what comments we get on this today too.
Yeah, we welcome those.
Team at consiliowealth.com. Thanks everybody for tuning in, and we'll catch you again soon.
All right, see ya.